Welcome to this lesson on volume analysis, part of our investment analysis series. Volume analysis is a fundamental tool that helps investors understand trading activity and market interest in stocks. By the end of this video, you'll know how to interpret volume signals and use them to make better trading decisions. Trading volume represents the total number of shares traded during a specific time period, such as a day, week, or month. It measures market activity and shows how much investor interest exists in a particular stock. When volume is higher, it indicates stronger conviction behind price movements. Think of volume as a measure of enthusiasm. If many people are buying or selling, something important is likely happening with that stock. Volume signals come in two main types. High volume indicates strong participation from traders and investors. It confirms price trends and provides increased liquidity, making it easier to buy or sell shares. On the other hand, low volume shows weak participation. It suggests an uncertain direction and can signal potential reversals. Low volume moves are often less reliable because fewer traders are committing to the current price action. Understanding how volume interacts with price is crucial. When price goes up with volume going up, that's a strong bullish signal with broad market support. However, when price goes up but volume goes down, it's a weak rally that may reverse soon because not enough traders are supporting the move. The most concerning pattern is when price goes down with volume going up. This indicates strong bearish pressure and distribution, meaning investors are selling aggressively. There are several important volume indicators to track. Average volume is a baseline measure over a specific period that helps identify unusual activity. Relative volume compares current volume to average volume for context. A volume spike is a sudden increase that signals significant news or events affecting the stock. Finally, on-balance volume, or OBV, is a cumulative indicator that measures buying and selling pressure over time by adding or subtracting volume based on price direction. Let's look at practical scenarios where volume analysis matters. During a breakout, high volume confirms the move and suggests continuation of the trend. However, a failed breakout occurs when volume is low, indicating weak conviction and a likely reversal back into the previous range. An exhaustion pattern happens when volume decreases in a trending market. This declining participation suggests the trend is losing momentum and a potential reversal may be near. Here are 4 essential tips for using volume analysis. First, always compare current volume to average volume for proper context. Second, use volume to confirm price movements, not to predict them, as volume works best as a confirmation tool. Third, watch for volume divergences as early warning signals. For example, if price makes new highs but volume is declining, that's a bearish divergence. Finally, combine volume analysis with other technical indicators, like moving averages or support and resistance levels for more reliable signals. To summarize, volume reveals the strength behind price movements and provides crucial confirmation signals for trading decisions. It tells you whether other market participants agree with a price move or if the move lacks conviction. By mastering volume analysis, you'll better understand market psychology and make more informed investment choices. Remember, volume is not just a number. It represents real buying and selling activity by thousands of traders and investors, giving you insight into market sentiment. Thank you for watching, and keep practicing volume analysis to improve your trading skills.
If you like this video, hit that like button and don't forget to subscribe. Visit codelucky.com for more such useful content.